Good morning and welcome to the Shenkman Private Client Group Accountant Attorney Spring Webinar Series. This program is entitled Tax and Estate Planning for the Modern Family When the Married with Two Children box doesn't fit. For those who don't know me, my name is Jonathan Shenkman. I'm a financial advisor, portfolio manager, and an accredited investment fiduciary at Oppenheimer based in New York City. The goal of all my programs is to bring professionals together to help them better serve their clients. This is done by educating attendees on the latest topics in wealth planning and by encouraging collaboration between a client's attorney, CPA, and financial advisor where appropriate. My practice focuses on working with high net worth families, businesses, and not-for-profits. I manage individual investment portfolios, trust accounts, corporate retirement plans, and endowments to help my clients achieve their financial goals. In addition to the 20 to 25 events I run every year, I also do a fair amount of writing on the topics of investing and financial planning. You can read my work in Barron's, CNBC, Forbes, Kiplinger, the Wall Street Journal, the CPA Journal, Trust and Estates Magazine, and many other periodicals. After the program, I'll send out a link to all the publications where I publish my work. Today, we're privileged to hear from Janis Cowhey and Levy, both based in New York. Janis is a partner at Marcum and is a member of its Trust and Estates practice group and the national practice leader of its Modern Family and LGBT Services practice group. Her focus is on complex estate, gift, and income tax planning, estate and trust administration, planning for same-sex couples and unmarried couples, individual and fiduciary tax compliance, and providing corporate counsel to clients. Crystal is an associate at Lassar Cowhey, a boutique law firm based in New York. She focuses on estate planning for high net worth individuals as well as estate administration for multi-million-dollar estates. Specifically, she works closely with fiduciaries through the probate process and complete administration. Today, Janis and Crystal will be speaking on tax and estate planning for the modern family when the married with two children box doesn't fit. And with that introduction, I'll now turn the program over to Janis and Crystal.
Thanks, Jonathan. We really appreciate the invite to be here today. We are absolutely thrilled to be doing this presentation. This is a topic that we are both very passionate about and we love to discuss. I know we only have a half hour and a lot to cover, so please feel free to reach out to either of us if you have any follow-up questions after the presentation. So let's start with, what is the modern family? Well, with the rise in divorce rates, longer lifespans, increased number of remarriages, cohabitating unmarried couples, mom, dad, and 2.5 kids are now the minority in our country, and the modern family is the new norm. So let's talk about what we mean by the modern family. Well, the variations are virtually unlimited. You have LGBTQ couples and families who may be married or unmarried. You have blended families. That could be second marriages, third marriages, fourth, fifth, even possibly. Children from prior marriages, children from prior relationships, children adopted in, children adopted out, children born via surrogacy or IVF. Another category we talk about a lot is cohabitating unmarried couples. And this can be same-sex or heterosexual. Most younger couples, I find in my practice nowadays, are just choosing not to get married or delaying marriage. They want to travel. They want to work on their career first, and they'll get married at some point, maybe. Older couples are choosing not to get married because of the complexity that comes along with marriage. And of course, the complexity that comes along with divorce. Another category that fills our modern family group is the intentionally single parent, which is also a growing area. Many women and men haven't found the right life partner, but they absolutely want to have children. They use assisted reproductive technology, surrogacy, or adoption. And all of these come with their own host of issues. As one of my LGBTQ couples told me, they fought for the right to get married, but not to actually get married. So let me turn it over to Crystal, and she's going to talk a little bit about the estate planning considerations for the modern family. Crystal?
Thanks, Janis. So now you can see that the modern family is actually more common than you would think. And actually, there's a number of reasons why there are some other factors you might want to consider in a modern family estate plan rather than you would in a standard estate plan for a traditional family. So for example, when you have these families of second marriages, adopted adult children, same-sex couples who are intentionally unmarried or even blended, Brady Bunch type family units, there's a number of issues. I put some bullet points on the slide, but I just sort of want to speak in general terms of what you guys might want to look out for. first of all, with most clients, as you would normally go through, like the interview process of taking a client's basic information, names, date of births. But for modern families, I feel like sometimes you need to dig a little deeper. You know, it turns out you have to confirm information with clients. It turns out oftentimes they're really not legally married after all. Maybe they just had a ceremony, or maybe they have a registered domestic partnership where, and if so, you have to find out where. You should also be digging a little deeper if they were previously married or divorced or separated. Is there a settlement agreement in place? You know, you don't want to be scared to ask an unmarried couple as well if they even plan to get married in the future. All of these factors can sort of change how you want to approach their goals and their estate plan. And you'd also be surprised how many clients actually forget to tell you this is their second marriage, or that they were planning on never getting married because they both already were married before and they went through a horrible divorce. And you'll find once a client is divorced and they go through that process, how they approach planning for their children, their family members, it really alters their thinking. And basically, once divorce is on the table and it becomes a real thing, they realize the importance of how to pass down wealth. For example, you don't need to convince them to put everything in trust. Suddenly they say, I want to trust, I want to trust. I don't care what happens. I don't know who my son or daughter is going to marry. So now we all know that's a good thing to do, right? But putting assets in trust isn't always the absolute solution. There's always other factors that can play a role, and you want to be careful how to structure that trust. But definitely having a basic creditor protection of a trustee, being the gatekeeper, can resolve a whole host of issues later on down the line. Also, on the topic of notes, on topic of trust, it's becoming more and more common to keep trusts in place for children's lifetimes or the beneficiaries' lifetimes, because you never know who they might marry, or if they get divorced, or even who they get in business with. And on that note, you also want to have conversations about why maybe spouses of beneficiaries will be included in that trust. Maybe they're not included, or maybe they are, but for a limited purpose, you know, limited to income, with a provision that the beneficiary and the spouse must be married during the term of the trust. Another important consideration to think about is who's going to be the trustee of that trust. You know, you truly want an independent person to avail yourself of all the marvelous things the trust has to offer. And you can end up creating a perfect trust for children or grandchildren. But then if you name the parents or one of the parents as trustee, and then there's a divorce, now you have an ex-husband or ex-wife that doesn't want to or doesn't care to cooperate. So you may want to consider trust protectors. You know, they can be extremely helpful to enable certain powers or make certain amendments to the trust. Also, another way to create some flexibility in the trust is to make sure you have decanting provisions in the trust. That way, if circumstances change, the trustee can always pour assets into the new trust. Also, you should think about powers of appointment. You know, powers of appointment can be a great tool in these types of estate plans. It's a way to give a family member the option to have the trust benefit others, even if it's just a portion of the trust or a limited power. You know, that gives them flexibility. That way, if the beneficiary never ends up getting married, or if they never have kids, they can always appoint a portion of the trust to a charity that they really care about. Other major considerations you want to think about are intestacy statutes. Too often, clients who don't have an estate plan in place end up accidentally disinheriting their significant other, or they don't know the rules regarding intestacy laws or the spousal right of election. And, you know, I'm not here to knock down millennials, because actually I fall into that generation, but I hear them say all the time, well, if I die, everything just goes to my wife. So do I really need a will? And of course, after I ask some follow-up questions, it turns out, well, they were never legally married, or they have one kid together, but they have two from prior relationships, but they treat them all equally. So what's the difference? You know, and that's usually the point where you have to inform them of the intestacy laws in that state. And more often than not, what the client thinks or wants to happen and what actually happens under state law is not the same thing. And when this happens with blended families or unmarried couples, stepchildren end up being inadvertently disinherited, and partners end up with no legal rights. So that really brings me to the next point: is one way to avoid that type of accidental disinheritance is to pay attention to definitions in documents. Every will and trust often has a definition section. And I think oftentimes practitioners look past this as boilerplate language. They say, that's really not important, but you might want to take a closer look at that, because how you define child or descendants can be a big issue. For example, does the definition of children include stepchildren? Does it include adopted children? Does it include children of surrogacy and IVF? Does a genetic child of a same-sex couple qualify as a child for both parents? What about siblings? Are half siblings included? You also want to look at definitions of spouse, and if there are provisions regarding the effect of divorce or separation. I just had a case where a client got divorced recently, and there were some trusts set up by the previous generation, and the ex-spouse was named as a co-trustee, but not a beneficiary. Now, when the trust document dealt with what happens if a beneficiary gets divorced, it wasn't so clear what happens if a trustee is divorced. So you might want to be careful about and mindful about those definitions and what people in our client's world that you want to include or don't include. On another note, you want to make sure that your documents are gender neutral where it's appropriate. You have to think about privacy considerations with modern families, especially now. For those of you who practice in New York, the Surrogates Court web online portal being launched now allows all probate documents to be made public. So make sure your clients know that. Moving on to my next point is disability and incapacity. A major issue that comes up here is difficulty obtaining medical records when couples are not married or the next of kin. Often the hospital looks to those people first, but that's why it's important to have more than just a will or a trust. You want to make sure that you have a healthcare proxy, a living will, powers of attorney, all the ancillary documents in place for that client, including a disposition of remains. And this is especially important for unmarried couples and even people who are separated or going through the divorce process. It might be a good idea to change their ancillary documents until the divorce is final. And you want to make sure you have those affirmative documents in place, because these are the people that are making healthcare decisions, financial decisions on it that could happen any day now, rather than a will or trust that may come into effect later on. And especially with the disposition of remains, you want to make sure that who's going to have the right to make burial arrangements. The last thing you want is a family member and the partner having a disagreement literally over your grave. Also, I don't want to go into too much detail, but you might want to consider Medicaid planning for modern families and try to name guardians where you can. Also, don't forget about beneficiary designations. Make sure that the client has actually properly designated primary and alternate beneficiaries. You want to ask to see copies of those forms. It's always the case for any estate plan, but it's even more important for modern families. It's no exception. And you also want to make sure that the attorney is well-versed in modern family issues in that particular jurisdiction where the client is domiciled. For instance, in Florida, a personal representative must be either a relative or a Florida resident. So if a client has a lifelong partner, but still maintains his or her residency in another state, he or she may not be able to serve alone, even if you appoint them. My next point is gift and estate taxes. And this is a big one. We all have to remember and remind our clients that unmarried couples are not entitled to the unlimited marital deduction or portability or split gifts on federal gift tax returns. Also, in certain states, you need to worry about inheritance taxes. because when gifts are made to non-relatives or persons that are considered a more remote class, there could be an inheritance tax due. Another issue on gifting, which is a common issue, is that indirect gifts are often made between partners who pool expenses. For example, one partner is paying all of the mortgage payments or the expenses of the other partner, and that is considered a gift. And if gone unreported, can end up being a problem. Which leads me to the next point or last point of cohabitation agreements. And these are really an excellent way to help define the rights and obligations of unmarried couples. Just as a prenup protects the assets of married couples, a cohabitation agreement or an ownership agreement protects the home for unmarried couples. It really memorializes the parties' mutual understandings and lays a blueprint for how expenses are going to be paid, what happens if there's a breakup or death, how capital improvements will be handled, the financial responsibilities of the parties, and many other important issues. And it's becoming more and more common, like Janis mentioned earlier, for unmarried couples to live together before getting married, if they get married at all. And for many people, this turns out to be, one of the biggest purchases they'll ever make is the home where they're going to live together. So it's much more than just figuring out how title should be held on the deed. Now, the last thing you want is to have your client in a scenario where one partner passed away and now the family members are trying to oust the other partner. So I went through several legal considerations. There's so many more, you can always reach out to me. We can talk further, but tax ramifications are just as important in the aspect of estate planning for a modern family. So I'll turn it over to Janis to go over some of those items.
Great. Thanks, Crystal. That was terrific. That was a good overview and even gave me a couple of things to think about. So I'm going to talk for a little bit about tax and income tax planning and considerations and things you need to take into account when you're working with a modern family. So the first issue that always comes up is how do you choose your filing status? As I'm sure most of you know, you must file married separate or married joint if you are in fact married. You no longer have the option to file as single. Many LGBTQ couples were unaware of this when they got married right after the 2013 Windsor Supreme Court case that allowed same-sex marriage finally at the federal level. And it took a lot of my clients by surprise. They'd say, well, don't we have the choice? Do we have to file together? And you don't have to file together, but you do have to file as married filing separate. Another category that's available to many modern families is head of household. If you can use the head of household filing category, you'll be subject to lower tax rates, higher exemptions, which can benefit the family. Now, say you have 2 children. Maybe you have the possibility of each partner claiming head of household. And then if you look at it as a family unit, you can probably reduce your tax bill. But you need to, focus on what your options are and what your family structure is. So then the next question, we get is, should we file a joint or a separate return? So as a general rule, most married couples will pay more in taxes if they file separately. The married filing separate was not put in to be a benefit. It was put in to handle families that were either divorced or separated and were unable to file taxes together, yet were required to under the law. But you're not going to generally save taxes by filing separately. Another general rule is that if you have 2 high income earners, they'll pay more in taxes than if they had both filed single. So it's a shock for a lot of couples. They file single for several years, they get big refunds back. Now all of a sudden they file married for the first time and they owe money. So it's about managing expectations. And we refer to this as the marriage penalty tax. I'm sure you've heard that in the news before. But you really need to run both sets of numbers and do an analysis because it's not always as obvious as you would think. There are some general rules and guidelines we talk about and discuss, but they don't always pertain to every client. So for example, I had a client this past year that one makes a significant amount of money and one makes very little money. He just graduated from law school. He has $300,000 in law school debt, making very little money, working for a not-for-profit. So we ran the calculation and they saved $30,000, $40,000 by filing a joint return. But the lower income earner had the opportunity to have his student loan expunged if he worked for this not-for-profit for, I believe it was 5 years. Then they would forgive his student loan. So we had to weigh that out. He had $300,000 in student loan. It's going to cost them maybe $30,000, maybe $40,000 more over time, but in totality, they do better by filing separate. So you have to really work through what the numbers are. So I think Crystal talked about the gifting that comes between couples who are unmarried, and there's a lot of unforeseen gifts that can be consequential. So I find when it comes to my practice, so who can deduct the expenses? You've got real estate taxes when you're in a house, you have mortgage interest. You know, what if your partner is the one who, say, inherited the house, but now is staying home with the children, and you're going out, you're the breadwinner, and you're paying all the bills? Technically, under the tax code, no one can deduct the real estate taxes or the mortgage interest. You know, under the code, you must be on the deed, you must be an owner, and you must make the payments to take the deduction. Now, there are exceptions, and I'm sure some of you are in the background screaming, no, 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 equitable ownership, which is a concept, but the cleanest is always to be on the deed to make the payments. And this is one of those things I talk about when I'm working with modern family couples. We tend to be historians as accountants. What we do is a client comes in at the end of the year with all their tax information, and we prepare a tax return. You know, our larger clients we're proactive with speaking during the year, but with a modern family, you always need to be proactive. There's a lot of planning opportunities you can do, but they must be done at the beginning of the year. You can't wait, and you can't undo a lot of things at the end of the year. So another question that comes up quite often is, who can take the children as dependents? Can you take your partner as a dependent? Well, the question is, first, do you provide more than half of their support? Do they live with you? The requirements are different. If they're unrelated to you, they must live with you to be your dependent. But if they're related, say you support your parents and they don't live with you, you can take them as dependents. Now, well, the laws have changed over the last couple of years, and there is no dependent exemption any longer, but you need to know who your dependents are for other things, like the earned income credit, the child and dependent care credit, the education tax credits, student loan interest deduction, medical deductions, many more things it's important to know. So another question that also comes up quite often is medical deduction for ART, which I mentioned previously, artificial reproductive technology. So you can deduct medical expenses if they are in excess of 7.5% of your adjusted gross income. Now, these ART procedures can be extremely costly and very expensive. And we found, and the case law has backed us up, that the deductibility of this is also biased against same-sex male couples. So I had a couple of years ago that they were a same-sex male couple. They obviously could not have children on their own, so they went out and found a surrogate. They went through significant medical costs for themselves, but mostly for her, to go through in vitro and all the procedures that needed to be done, and then to give birth to their child. And they asked, can we deduct any of these medical expenses? And the answer was no, because she was not considered their dependent. And you can only deduct medical expenses if they happen to you or they happen to your dependent. And that was the case in neither of these instances. Well, meanwhile, if you were a female same-sex couple, these procedures are all happening to you. One of you is the one giving birth to the child. So you can deduct all your medical expenses. So while the tax code is worked to be gender neutral, it still doesn't take into account necessarily the modern family. So here's a planning opportunity now for an unmarried couple. So the mortgage interest deduction limitation. So generally mortgage interest deduction is limited to the interest on the principal mortgage amount of $750,000. Used to be $1 million, it was decreased to $750,000. But the key is this limit is per person, not per property. So therefore, if you have an unmarried couple, they can essentially double up on the mortgage interest deduction. If an unmarried couple owns a house together, pays the mortgage together, and they can deduct the interest on the principal up to $750,000 each. This also works for real estate taxes. We have a cap currently of $10,000, but each has a cap of $10,000. Another planning tool we've used with some of our unmarried couples is they wanted to sell some assets, recognize the loss, but they didn't really want to give up the asset. And I think most people know there's a wash rule. If you sell something and you buy it back in the next 30 days, you can't do that. So with unmarried couples, you're legal strangers in the eyes of the law. So you can sell your depreciated assets to your partner, take in the cash, you recognize the loss, and while you've kept the asset in the family at the entire time. Another issue that's important for Modern Family is the adoption credit. So if you adopt your partner's child before the wedding, you can avail yourself of the adoption credit. But if you wait and adopt your partner's child after the wedding, there is no adoption credit. You are not entitled to an adoption credit if you adopt your spouse's child. In 2020, the credit was $14,300. It's a significant number. I had a couple when we walked them through this said, wow, that helps pay for our wedding. So I think Crystal alluded to, and I'm really going to talk about divorce, settlement agreements, unraveling issues, unraveling assets for a Modern Family is an issue. And I want to just say, we get this question all the time. And I'm sure some of you have. Clients come to us all the time and say, should I get married? Well, we tell them first, you have to decide if you actually want to get married. We can't help you with that question. But then we need to run the numbers. What are the income tax consequences? What are the estate tax consequences? What about Medicaid, as Crystal mentioned? What about gift taxes? You really need to make an informed decision and have a holistic plan when you're dealing with the Modern Family. Okay. Crystal, you have anything to add to that?
Yeah, I know we're running out of time, but just to follow up on what Janis is saying, it's really important to come up with a plan that's sensitive to each client's particular situation. You want to go beyond just drafting ordinary documents or doing just a standard tax return. You want to know the whole picture. You want to avoid issues. You want to put your clients, find out the best options for them so they can make informed decisions and have the best outcome. And also you want to just remember that each family has its own dynamic. So if a client is agreeable, maybe suggest family meetings, have open communications, meet with your professional advisors, maybe have a sit down with your lawyer or your accountant or your financial advisor. That way, your family knows what's going on, everybody's made good decisions, and everyone's comfortable with the estate plan.
Terrific. So there's just two things I want to conclude with then. I want to invite all of you, Crystal and I, or Marcum and Lassar Cowhey, do a monthly webinar called Pivot to Plan, Plan to Pivot, where we talk about some of the things that are going on right now, Modern Family and elsewhere, especially in this crazy world we're all living in. If anyone's interested, just email either of us and we'll put you on our email invite list, or you can go to Lassar Cowhey's website, it's under events, or on Marcum's webpage, it's under events. But I think, just to feed off of what Crystal said, I think the key here is surrounding yourself with the right team of professionals for your client, somebody who has an expertise in the Modern Family, because these are not, when Modern Families come to me, I used to say, when you go to your doctor and something hurts, something's wrong and you're waiting for an answer. When a lot of these couples and families come to us, they have no idea of these issues or these problems they have. So, we need to be proactive in planning for them and pointing out and finding, ways where they can save dollars in tax or just take care of their family properly. And most of that is about having the right team in place. You have to have the right financial advisor. You have to have the right estate planning attorney. You have to have the right accountant, life insurance, matrimonial, divorce attorney. Everybody has to work together. Because I find when people act separately, they're not acting in the best interest of the client. So I think everybody needs to work together. So I think that's about it for us.
Great. Thank you so much, Janis and Crystal. If anyone has any specific questions or new business opportunities or any other issues they'd like to discuss, please feel free to reach out directly to the speakers or myself where appropriate. And I'll be sure to include their contact information in the follow-up email to this program. There'll also be a link to the handouts. As I mentioned at the onset, the goal of these programs is to stay up to date on timely wealth management related topics and to collaborate where appropriate. And I think we can all agree that the clients who are best prepared are the ones who are served by a team of knowledgeable advisors. Two more quick items before I let you go. First, my next program and the start of my summer webinar series will be on June 15th and is entitled New York Real Estate Post-COVID-19 Strategies and Perspective. This program will be a panel discussion on various aspects of the New York real estate market, from residential, office leasing, contracts, estate planning, using real estate, and much more. It should be especially timely program given how the real estate market was impacted by COVID and the economy's subsequent reopening. You'll receive an invitation to this webinar and all of my upcoming sessions in the coming days, and I hope you can attend. Second, be sure to take 30 seconds to fill out my survey at the end of this program. It helps me improve my webinars and provide timely and interesting content to attendees, and I thank you in advance for taking the time to do that. And with that, this concludes today's session. Please stay safe and healthy. Have a wonderful day, everybody.
Thank you.